this bear market has been difficult for retirees. And so you might be asking yourself, is it over yet? Today, we're going to talk about the different sides of opinion on this topic, and we're going to talk about 3 action items that you can take today so that you can be more confident in your retirement plan. Stay tuned. Hey there, it's Alex and Anthony from 1 Degree Advisors, and we help you gain confidence in your retirement. So Anthony, let's take a look at this chart here. I mean, the market has recovered a bit from its lows back in October of 2022. And so some people might be arguing, it seems like the bear market might be over. We've had some reprieve, but the truth is that the yield curve is still massively inverted. In other words, an inverted yield curve means that short-term debt is paying out a higher yield than, let's say, longer-term debt. And under normal economic circumstances, that simply isn't the case. And the thing about an inverted yield curve is that when the yield curve inverts, it's predicted a recession 100% of the time since 1955. And again, the question here is, isn't an investor's famous last words, isn't this time different? So is this time really different when we're looking ahead?
Yeah, and you wrote a great blog post on inverted yield curves, and we'll go ahead and post that so you can learn more about it. I think the counter argument when we say, well, maybe the stock market is recovering and maybe it is going to hold, is that interest rates have come up so much, so fast, that if things really did turn negative, now the Federal Reserve has some dry powder, so to speak, to bring interest rates back down. And that could be the tailwind that stocks need at that point in time. There is that saying of don't fight the Fed, and certainly stocks have had that headwind as interest rates have come back up. But if things got bad, the Federal Reserve could bring interest rates back down again.
Now, the thing, though, is that the Fed has made it explicitly clear, Powell has made it explicitly clear that they want to get back to a 2% inflation target, right? And so we're still not anywhere near that target. Yes, inflation has come down a bit, but we're still not close to that. They don't want to relive the mistakes of the 70s. And so Powell is going to make sure they do everything in their power, at least that's what he's communicating, to make sure that they get to that 2% target. Now, the other thing is that the market has never recovered, or at least it's never bottomed before a recession. And the NBER, which is the National Bureau of Economic Research, hasn't technically announced a recession yet. And so if that's truly the case, if we're technically not in a recession yet, there's argument that could be made that maybe we're going to retest those October 2022 lows again.
Yeah, that's right. I mean, if you go back to recessions, I mean, the investment markets, the stock market does anticipate, right? It tends to start recovering at the beginning or somewhat in the middle of a recession. And if we're not even in a recession yet, that is the big argument, is that, well, maybe the stock market has to come back down since we're not there yet. I think the counterpoint to that, though, is like, isn't this the most anticipated recession over? It's that slow-moving train that's coming towards us. Has the stock market just simply said, well, let's get the downturn out of the way and therefore move towards that upward trend right now?
Yeah, the other thing, too, is that, I mean, we live in such a connected world right now. I mean, think back to previous economic recessions and previous market declines. We didn't have social media like we do today. We didn't have the speed and breadth of communication like we do nowadays. So, there's argument that could be made that because things have changed and because people are more aware of these indicators and things like that, it is very possible that this time is different because everyone is aware of it, whereas before, not a lot of people were. You got your New York Times in the mail, maybe, every now and then you got caught up. Nowadays, people are doom scrolling Twitter every, 30 seconds looking for the latest tidbit, and it keeps people on top of it.
Yeah, things do move fast this day and age. What doesn't tend to move, though, as fast is inflation, and especially as it's coming back down. And so what we're seeing is that inflation may not be where we want it. Maybe we're still paying too much in the grocery stores, but there is disinflation taking place. And it does tend to really lag the rise in interest rates. And the economists know that. The Federal Reserve knows that, is there is going to be a lag in prices slowing down after interest rates. In other words, it's headed in the right direction. And if we can get that big thing out of the way, inflation, is that the precipice that stocks need to continue the recovery?
Yeah, and it certainly could. Now, when you look at U.S. small business sentiment, it's been declining. It's declining at a rapid pace. In fact, it's even lower than it was during COVID of 2020. And in some ways, that can be bad news because U.S. small businesses are the lifeblood of the U.S. economy. And so, if what you're saying is, look, U.S. small businesses are quite pessimistic, that means they might not incur as many capital expenditures, they may not spend as much, they might not grow as much. That can lead to a contracting economy. Overall, that's just not good. So, in some ways, these indicators like business sentiment can be a leading indicator of what is to come.
Yeah, and one more quick thing before we get into the solutions is that there has been a lot that's going around that says, well, when the Fed gets ready to pause on interest rates, stocks go up from there. And that's not necessarily true. Liz Ann Saunders put out a piece, she's from Schwab, and we'll go ahead and post that the results are actually pretty mixed. All right, so let's dig into some action items, some key takeaways that you can apply so that you have confidence in your investment plan going forward with the uncertainty that's presented. Number one would be trade the news for well-researched investment material. You have to remember that the news doesn't have your best interest in heart. They want viewership, whereas looking
they want
at
clicks.
Yeah, they want clicks, right? And they want to keep you watching, and so the news tends to get more extreme. We see it be very partisanship, a lot of arguing that's going on. If you really want to get caught up, look at the stuff that is deep research, that's principle-based, and shameless plug, but our investment philosophy, not that our philosophy is the only way to do it, but point being is that it digs further into good academic research. We'll go ahead and post a link to that. It'd be a good place to start.
The second thing I'll make pretty quick here is just control what you can control, right? You can control your spending. In some ways, you might be able to control some of your taxes. That's why we're such big advocates of tax planning. But controlling what you can control, the things you can't control necessarily the market, focus on the things you can control. That puts you in the driver's seat and less of a victim. You don't want a victim mindset in any of this.
Yeah, all that other stuff's going to happen either way. You can't control the direction of the market. All right, number three is invest according to your timeline. So you might be asking, well, if I can get 5% on a CD at the bank, why not just keep my money in cash and forget about stocks and the volatility that come with that? Why do I need bonds at all? We actually think you should have all of them. We posted a video recently that talks about retirement investing. Where's the best place to put your money when it comes to retirement? And it actually talks about both cash, bonds, and stocks, and really aligning your investment plan with your time frame.
Once again, this is Alex Okagawa with One Degree Advisors. And if you found today's video helpful, please like and subscribe for more. It helps the channel grow so we can reach more retirees just like you, retire with confidence. We recently posted a guide called 5 Retirement Mistakes to Avoid, and we found that these are mistakes that most retirees make, and they are critical to avoid so that you can have a long, successful retirement. You can download that guide for free in the link below.